Good afternoon, everyone. Today is February 29th, 2016. This is Trader Tim bringing you another Monday market analysis video. We're going to jump into the ES and how to kind of get into the short trade that we have here in a very low risk setting. When we're coming up to the 50% retracement that we've touched now a number of times, and we talked about the last couple of videos really how we're kind of stuck between these two 50s. When we come up into a 50% and we get a test that's, a pretty sharp reaction, but then we come up and we start to trade within the 50, in other words, in between the 50 and the 61.8. So we're a little bit dirty, meaning we're piercing between that. There can be some interesting anomalies that happen, and it can be tough to just keep shorting up here when there's nothing really. You're just kind of trying to short out of thin air, so to speak. The market's rising, and you're just trying to take stabs at these shorts. So I've got a better way to kind of go about getting short at these larger areas that I'll talk about here in a minute. The other thing I wanted to mention or ask you guys, because I have had some questions come in about why I use Infinity futures over Thinkorswim for trading futures. I do trade stocks and options and have all my retirement stuff with Thinkorswim. Now TD Ameritrade, but I don't trade futures with Thinkorswim. When I first started, and this was probably 2009 when I first started trading futures, I started with Thinkorswim, and there just seemed to be a lot of slippage at the time. I was just trading the ES, but you'd place orders and you wouldn't get as good of fills, or there'd be slippage, so you get filled at a worse price. And when I moved over to Infinity right away, the orders and the slippage just were like clockwork. If I put an order out there, it was filled at that price. So I kind of moved away from Thinkorswim for trading futures, but I've heard that over the years they've improved, and I do have a few colleagues that do use Thinkorswim exclusively, the active trader platform, for futures. And I'd just be interested to know your feedback. So if you do use Thinkorswim, feel free to drop your thoughts in the comments below the video, and maybe I'll start trading with both Infinity and Thinkorswim. But for now, I've just and for the past 6-7 years, I've really just stuck with Infinity futures for my order execution, and then use Thinkorswim for my other trades, stocks and things like that, along with my charts. So let's talk about how to get in a short setup when we're not shorting at the daily level itself. So I'm going to go to 15-minute chart, and I'm going to actually turn off the extended session, because a lot of times we're just actively trading in the first couple hours of the day, or the morning session, the first half a day, if you will. And some of the overnight stuff, since it's such low volume, it can kind of cloud the environment, if you will, kind of just add noise. So looking at the move up first, we went up really sharp. So we never got a 50% retracement, and even pulling from lows all the way to highs, we have still not pulled back into the 50% retracement. But in the meantime, it's okay to take shorts down into a larger 50% that could be below us, because the daily short is such a powerful level. So we're sitting up here at this daily short. We've got we had a extension from high to high that took us then even further higher. So the market, the bullish action, whether it's shorts covering or bulls stepping in, there's a lot of hasty bullish pressure. So rather than just sitting up here and taking a blind limit order every time we come up to the 1939 level, what I like to do is go to the 512 tick chart. And so if we go to today as well as yesterday, I'm going to flip on the Heikin-Ashi candlestick. So yesterday was the high of this move where we kind of opened up and then started trading lower right off the open. We've got actually Friday, yesterday I'm saying, but Friday. When we get these, well, actually let me go back just to the daily chart real quick so we can get a little bit more context. And so, Friday we gap up and then we sell off. So after a move up to then gap up, if we don't gap and go right on the open after we've had this strong move up, then there's a really good chance that we're going to be selling off and moving lower just because we've moved this high already. So if the market is, or the traders are jumping in at highs to push the market higher and it can't go higher, then it can only go lower. And I know that sounds really simple, but when we gap up at highs, it's often likely to fail. Just the same as if we gap down, see down here, we gap down at lows after moving lower, 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 lower to then gap down. You get these traders that are then essentially exhausted, where there's no more sellers, or up here there's no more buyers, and so the likelihood to fade the gap, or to fill the gap or move in the opposite direction of the open or of the gap is very likely. So let's go back to the 512 tick chart. And so simply looking off the open for shorting opportunities when we gap up like we do is what I like to look for. So turn off trading hours only. So now this is yesterday, and looking at just pulling right from the open from highs to lows and getting short on a 512 tick setup. Now yesterday was a little bit, I keep saying yesterday, Friday, we had a little bit of, that immediate sell-off to the gap fill, and then a bounce, and then a pullback. And that bounce that we had kind of middle of the morning, it kind of, if we were to draw from highs to lows, there was a sense of, in the morning, a kind of a V shape. Oh, we sold off, we filled the gap, and then we get this nice bounce. Well, today we had another great opportunity to get into the short. So what I'm trying to convey here is, when we're up at these larger daily levels, we may trade into the daily level, and we may chop around a little bit. There may be some fake outs and some moves that kind of take us a little bit higher, and then we get what looks like a sell-off, and then the bulls step in and we kind of chop around. And that's kind of what we had on Friday, where we had some selling opportunities, but there wasn't a ton of follow-through. We moved down 10 points or so, and then boom, right back up. So if you were trailing your stop from the full 50% retracement, you'd end up getting taken out with not a huge move, not a huge amount of follow-through. Well, today, after moving back higher, if you were to just look at a larger 15-minute chart and take a random 15-minute, you'll see that the 15-minute pierced. So there's not a whole lot of opportunity of just picking any random 15-minute when we're up at these big daily shorts. If we had one 15-minute setup trade, entry to target, then taking the next setup is totally fine. But I don't like to just blindly take a daily level or just a random 15-minute just because I can, essentially. So what I like to do is kind of come in here and wait for a break of the of a smaller move up. And so in this case, this morning, if you were to draw from lows to highs, and seeing as we had a break of that move and a kind of small break of the swing, that gives you the opportunity to take a 512 tick setup short. So drawing from highs to lows, even if we're just waiting for a high point in the day to get short, the key though is really letting the uptrend. So open in the morning, move sideways, started to move higher, and then we had our first break of the move higher. We traded failed the 61.8, and so we can take the first 512 tick setup in the opposite direction. So if we didn't fail this 61.8, then this wouldn't be a valid setup. But because we know that the daily level is a short, and we're looking for shorts up here after we've kind of exhausted ourselves, exhausted this move higher, we let the long setup fail and then take the first 512 tick setup. And because we're using a small stop, 6 ticks, even if the setup didn't hold, if we traded higher, kind of no harm, no foul, because the stop is small, but also we're entering at a very small time frame. So we're kind of pinpointing our entry a little bit better. And then from there, it's just a matter of trailing the swings as we move lower. And a couple things I want to mention in trailing swings. You want to make sure that you trail, so you're starting your trail stop above the entry candle's high. We make a low, and then we come back up. Now, you don't want to move your stop until we break the previous swing low, because sometimes you get into these little kind of double bottoms. You get a pierce of the swing high, and then you get a big move lower. And that's what you don't want to get shaken out of by tightening your stop too much. So rather than moving my stop above this swing high, I like to wait for a break of the low, break of this low back here, and you'll see we just double bottomed. So letting the low break as it did over here, then you can take your stop from the entry high down to the next swing high. And then we broke lows. And then over here, and so this just happens to be a really good example of both of these scenarios that I see quite a bit, where we get a double bottom. So not being so aggressive with my trail stop that I move it right down here, we double bottom, and then we just pierce it, get taken out, and then we get the sell-off, and you're no longer in the trade. So letting the swing low break before moving your stop down is important, and just flip these over for long setups. But then the other thing is important is not moving your stop down if we have just a series of inside bars. So you'll see this candle here, the 48.50, or just above 48.78s, we'll call it 75s, kind of the high here and the low encompass all of these little guys right here. So rather than taking, forming a low, getting what you could kind of call a bounce, but not really, because we didn't break the high of the low bar, letting the market kind of come up a little bit and get outside of the lowest bar here, break the high of the low bar, and then break the swing low that we were just talking about back here. Then is when I'll take my stop from this swing high and move it down to the next, or this swing low and move it down to the next swing high rather. So yeah, swing high, swing high, swing high, and then swing low, swing low, swing low. So letting the low break and then moving your stop to the next swing, and then letting the high of the low candle break for that actual bounce, and then taking your stop from this swing high over here down to the swing high over here. So we've got a nice series of lower highs and lower lows, but a little bit of chop in between. And so the trick is to not get taken out in this chop, but also be, you know, not so conservative that your stop is up here at 55s and the market's down here at 45s. So, you know, just continuing to trail your stop on that criteria will help you stay in the trade longer. And so, you know, it's these kind of moves that we're looking to capture. You know, there's trading opportunities that present themselves, and when we're in these kind of markets, you know, maybe you get shaken out, but again, no harm, no foul when you're using such a small stop. And then when we get into these kind of environments where we finally break a retracement, we can take the retracement in the opposite setup with that tiny little swing low break over here, and then trailing our stop allows us to stay in the trade for a much longer period of time. So that's kind of how I look at getting into trades around these big levels. You can't always just limit the 50 and at a daily level and expect the market to touch it exactly and then tank, or you know, come down and then bounce. So when we get into these dirty situations where we're trading in the 50, you know, I'd like to zoom to the 512 tick chart, and that's kind of how I manage the trade. So I hope that was helpful, and if you have more questions, feel free to pop them in the comment box below. And like I mentioned at the beginning of the video, if you do have experience trading live with Thinkorswim, not interested in the, you know, paper side of things, but if you're trading live futures with Thinkorswim and you have some feedback on slippage and just any feedback, feel free to pop your thoughts in the comments as well. So thanks a lot. We will talk to you again soon.